I'd like to discuss gaps. Gaps are fairly common in stock trading and in the stock market, and they usually happen between day to day. So let me show you what a gap is. Okay, so let's say a stock is trading, it's going up, it's going down, it's trading, and the end of the day closed here. Okay, so the stock ends trading at this price level. On the next day, a stock can gap up and start trading here and make movement. So basically all this is considered a gap. A gap is where no trades took place between one moment to the next. And it happens fairly frequent on intraday charts from one day to the next, and less common on weekly charts or even monthly charts. And the reason for that is because things on a day basis from one day to the next, things like an earnings report or the psychology can come out. Something, within the fundamental of the company or the industry can change from one day to the next. That's why there could be some risk if you're a swing trader versus a day trader. Now, it can be great if you're on the right side of the trade. Now, as far as weekly charts are concerned or on a longer term charts, they can also have gaps, but usually that would happen over the weekend, and it's not as common, but it does tend to happen. So there are 4 types of gaps that we're going to go over, and we'll start with those in the next segment. The 4 types of gaps that we're going to discuss are the common gap, the runaway, the breakaway, and the exhaustion gap. Now first, the common gap. Common gap is very, very common, and because it's very common, there's usually not anything that you can trade off of it. You just have to kind of keep an eye out on it and know and understand that normally it's going to be filled, meaning prices will slowly revert to that gap. So if you're trading and you see something like this happen and a stock gaps up, there was usually a low trading volume or something, and then somebody all of a sudden stepped in and the stock gapped up, and then eventually it will go back down and come back up, which is why they say typically gaps get filled, because there was low trading volume in that area. It'll get filled and then it might continue on its way. Now, with common gaps, there's usually not much you can go off of. They happen all the time on intraday charts, either on the downside or on the upside. So it's just fairly common. Just keep an eye out on it and understand that they typically get filled. So breakaway gaps are a little bit more meaningful. They're a lot more exciting, and there's something that you can trade off of there because it takes time to develop breakaway gaps, and they can happen right in the middle of the trading day. So they don't have to happen over the next day or from day to day. It can happen at any time. But breakaway gaps is a downward momentum move, and what happens is as a stock is trading and it's going along this support line right here, it's moving and it's moving in all sorts of ways, and it's creating this support line, and all of a sudden sentiment changes and it's going to this downside, and it dips down right here, and then again it continues trading. So this part creates the gap, and this can be from, let's say we're in month 1 here, this is in month 3 here, so it can be building for multiple days. All of a sudden the sentiment and people's psychology change that, it's building, there's a lot of support, but that stock just didn't go anywhere, and people just say, you know what, since it's not going anywhere, I'm going to sell it, and all of a sudden it just keeps pushing it, and boom, the stock gaps down, and then everybody just slowly starts dumping all their shares, and that's why the stock goes and it starts selling to the downside. So that's basically a breakaway gap, and it's going down to the downside. A little added point regarding the breakaway gaps is you want to make sure you see increasing volume. So in here, volume might be consistent or even, but when you get to that gap point, you want to make sure that the volume is much higher than the volume here. That way you can be sure that it's confirmation or confirming the move to the downside. Also, another important point is it's great if the breakaways happen with some other kind of pattern, like a descending triangle pattern or some other chart pattern. This way you can also be sure that it's a healthier gap and it's moving in the right direction that it's supposed to move. All right, let's talk about the runaway gap. The runaway gap is very similar to the breakaway gap. Instead of going to the downside though, it's going to the upside. And I have 3 examples here that the runaway gap can go through. The first one being is it starts with a downward trend and then it goes back up, it hops, and it continues going. Or it's going on an incline already, it hops, it does a gap, and then it continues on its path. Or it's going on a downward trend and then it jumps back up, slingshotting and gapping up. So you can do it all kinds of ways, but the runaway gap is basically a stock price jumping up towards a new level. And this usually happens with new product releases, product launches, news events. Anything that creates positive sentiment creates a runaway gap. Again, these are also more powerful if they come out of some sort of ascending triangle or trend line or anything like that. So there's just some kind of confirmation behind it in that way if they break a trend line. And you also want to see it on increasing volume. The last piece of the puzzle is the exhaustion gaps. The exhaustion gaps are probably another one of those gaps that are the most exciting or very good to trade with if you watch them. However, they can be extremely dangerous if you are still new or aren't spotting them correctly and you're looking for it to go in the wrong direction. So let me show you what an exhaustion gap is. Basically, an exhaustion gap happens when something shoots up very, very high and then it jumps and does another gap, or something goes very, very low, it jumps down and then bounces back up. So you want to be really, really careful with the exhaustion gap. So let me show you. So let's say a stock price is kind of going here, it's trending, and then all of a sudden it creates this supernova effect. And from here, it jumps up right here. But notice the incline or the slope of this line it's extremely huge. It's not healthy for a stock to do that. And then if it jumps up and gaps up and then again trends up a little bit, eventually it will go and plummet down, or at least slowly start to decline, even if it's slowly this way. So you want to be cautious with those exhaustion gaps because typically they happen in a state of panic. If the stock goes up very, very high, people in this area now are panicking in order to get more. Oh my God, it's going up. It's a psychological mindset. Or new people are saying, wow, this stock is amazing. Let me go ahead and purchase some of that stock. So they start buying it. And then all of a sudden, price gets too high. Everybody just says, wow, this is just way too crazy. I'm gonna sell some of mine. Once selling starts to take place, everybody else starts dumping and it becomes a state of panic. So be careful with those exhaustion gaps. That's what happens with exhaustion gaps. And they can happen to the downside as well. So if you're going to the downside and you're doing a healthy decline and then all of a sudden it drops, then you have another section where there's a gap right here. This would be my gap. And then again, it goes decline and then it'll shoot back up because prices are just way too low. And same sentiment happens just in reverse for that, for the exhaustion gap on the downside. So be aware of those exhaustion gaps. They can be great money-making opportunities because they're in a state of panic, but you have to play the opposite role when trading these exhaustion gaps.